If there was a lesson to be learned from Alphabet and Microsoft, it was that this was a high bar earnings quarter. Investors kind of wanted to see some tangible effect from all of the AI chat and investment of the last 12 months. Now we have Apple, Amazon, and Meta on deck. Do you frame this as a high bar quarter?
I do. Thanks for having me on the show. It's a high bar quarter because although fundamentals were really strong in 2023, multiple expansion also took place in a big way. And so when you have that multiple expansion and good earnings growth in 2023, the bar is now set for growth on top of what we saw. And that multiple expansion is going to be harder to get. And so I think that's where, the game of expectations really comes into play.
There is other technology in the world outside of this. We call it the Magnificent Seven, and maybe Tesla gets taken out and it's the Magnificent Six. Are we not looking in the right place right now?
We think the market should broaden out. We really believe that in the back half of last year, and as we look forward, we think that's true. Look, there are really good earnings prospects for several areas of the market. If you look at historic discounts between small and large cap companies, those historic discounts are really pretty wide. And you're right, there's really good companies, technology companies, healthcare companies, other companies that go down market cap that just don't have the multiples, that didn't get the multiple expansion. Even some that have really high free cash flow did put up good fundamentals last year. And so those are the parts of the market that we're much more attracted to right now.
Do the same drivers of growth apply, though, on the smaller side of the market capitalization? Is it that you want to hear from CEOs how they're leveraging AI, how they're thinking about cost discipline, how ultimately they're replacing people with machine?
Absolutely. AI is, not something that's going to go away. And I think we saw the first wave of it, certainly led by these large companies. I still think that the large companies are going to lead. But what we're going to do is start to see AI applications be applied across the broader economy. And when that happens, you're going to see productivity and other things continue to rise. But it does take a while for it to play out. And so we're looking for individual companies that are applying AI, but not just AI, also other tools, also other capabilities that they have to really work through the current environment, which we all know, is likely to be still a little bit bumpy here.
Let's talk about that current environment. End on the macro for us, Anne, because is it therefore the jobs data that you look to at the moment? Is it still any hint of direction of Fed policy that really dictates trade here overall?
I think the Fed policy, it's interesting. The Fed talk has maybe added a little bit of confusion, but the expectations for 5 to 6 rate cuts for the year were just higher than what we believed would actually happen. So yesterday wasn't so much of a surprise to us here at Allspring. What I would say, though, is we are watching the labor market really carefully and how that might be tied to company profits. And if we just go back to 2022, the technology companies actually were, cutting back on labor. Some of those Mag 7 stocks you talked about, that led them and set them up pretty well to produce good profits in 2023 with some recovery. We are, at the end of an inflationary cycle, pricing power starts to slip away. There starts to get to be some margin pressure amongst many companies. And so what then tends to happen is they start to unwind labor because that's where the biggest costs come from. So how closely are profits and labor tied? I think they're pretty closely tied. So we'll have to watch profits very carefully and within each industry, and then also what that might mean for the labor market.